Right, so the autumn budget 2025 has finally landed, and honestly, it's not as bad as a lot of people thought it would be, especially after that pre-budget press briefing Rachel Reeves gave, which caused quite a bit of panic, quite frankly. If you were braced for big hikes in income tax or national insurance, you can relax a bit, and you knew a but was coming. This is very much a stealth tax budget, so if you care about your take-home pay, your ISA, your pension, or your dividends, there's quite a bit you need to know. In this video, I'll break down what's actually changed for income tax and NI, what's happening to ISAs, the new cap on salary sacrifice pension contributions, and the rise in dividend tax, and what that means if you rely on dividend income and for small business directors. Let's start with the positives. Interestingly, before the Chancellor even stood up to speak, everyone already knew most of the bad news because the Office for Budget Responsibility, the OBR, accidentally published its forecast early. That leak laid out roughly £26 billion in tax rises by 2029 and suggested that 1 in 4 workers will be paying higher tax rates by 2030. It also confirmed that the UK's tax burden will rise by around 38% of GDP by 2030, the highest in modern history. So here's the silver lining. There were no major extra surprises today on tax beyond what had already leaked in the days and weeks leading up to this, and that's why this budget doesn't feel as brutal as it could have been. No increases in income tax rates, no increases in national insurance rates. Instead, it's lots of smaller, quieter moves that over time could add up to a large tax rise. So let's get into the stuff that actually hits your pocket. First is income tax. Income tax rates aren't going up. National insurance rates aren't going up either. But personal tax thresholds are frozen until 2030, extended for another 3 years. And that's the real tax rise. Because as your salary goes up, even if it's just inflation or a small raise, more of your income gets taxed. More people get dragged into higher rate tax. An additional rate tax catches more people at the top. The OBR estimates this freeze alone will raise more than £8 billion by 2029 and push hundreds of thousands of people into higher tax bands. So, no headline tax increases, but your tax bill still goes up. Now, onto ISAs. The good news is the overall ISA allowance stays the same. You can still put up to £20,000 a year into your ISA in total. But for savers under 65, the cash ISA allowance is being cut to £12,000 from April 2027. Meaning, if you want to use the full £20,000, at least £8,000 has to go into a stocks and shares ISA or another investment wrapper, not all into your cash ISA. So the government is essentially nudging people toward investing rather than hoarding cash. Now, in theory, that's fine. Long-term investing usually outperforms cash, but not everyone wants investment risk. Not everyone understands investing, and some people may put that money into stocks and shares ISA and not invest, which technically defeats the purpose. So yes, this might encourage more people to invest, or it might just confuse people. We'll see. Now, salary sacrifice. Salary sacrifice is where things get painful for higher earners. If you're new to it, salary sacrifice is where you agree to give up part of your salary and your employer pays that amount into your pension instead. In return, you both save on national insurance and you get your income tax relief as source. But from April 2029, only the first £2,000 of salary sacrifice pension contributions will be fully tax efficient. Anything above that, pay tax on it, meaning the main tax advantage disappears. Now, most basic rate workers won't hit that £2,000 cap anyway, so they'll feel little to no difference. But if you're a higher rate or additional rate earner who uses salary sacrifice to reduce your taxable income, or if you put big chunks of your bonus straight into your pension, this hits you directly. If that's you, now's the time to check how much you sacrifice. Calculate how national insurance will change your net contributions. Consider adjusting your strategy or front-loading your contributions before 2029. And don't leave this until the last minute. Give yourself time to plan. Next, dividends. Dividend tax is increasing by 2 percentage points across all bands. For investors who live off dividends or rely on passive income, that's a direct cut to after-tax returns. If you're a basic rate taxpayer, your dividend tax rate goes up from 8.75% to around 10.75%. Higher rate goes from 33.75% to around 35.75%, an additional rate moves up as well. This will hit anyone living off dividends, anyone investing outside an ISA or pension, small business directors who pay themselves through dividends, people with rental property income inside a company. On top of that, remember that dividend allowance, which is the amount of dividend income you can receive tax-free, has already been slashed to £500 in previous years. So most dividends you receive outside an ISA or pension would now pay tax, and at a higher rate. So the obvious response is to use ISAs and SIPs first. Always keep dividend-heavy investments inside tax-efficient wrappers. Reassess whether dividends are still better than salary if you're a small business director. Consider bet an ISA strategy to move investments into your ISA with general investment account. Look, this budget could have been a lot worse. They could have raised the actual income tax rates. They could have slashed the full ISA allowance. They could have cut pension allowances. But that doesn't mean it's painless. It means you need to be more deliberate about saving, investing, and retirement planning. If you're on average pay, saving modestly, building up a pension bit by bit, and not heavily invested in dividend-paying shares, then the impact is probably manageable. You might feel a pinch now and then, especially if you get a raise. If you're a higher earner, maxing out your ISAs, using salary sacrifice, or generating passive income from investments, then this budget makes things tougher. Tax efficiency is reduced, and the reward for saving is lower than it used to be. Here's a quick roundup of other budget announcements. Starting with the positives, defense spending rising to 2.6% of GDP by 2026, which is good news for defense stocks and ETFs. The two-child benefit cap is being abolished. Minimum wage is increasing. And the negatives, more HMRC crackdowns on tax avoidance schemes, a new mansion tax, so £2,500 per year on properties over £2 million and £7,500 a year on properties over £5 million. So, ask yourself, am I using my ISA allowance properly, especially for dividend-paying funds and shares? Should I move investments into a stocks and shares ISA? How will the salary sacrifice cap affect my pension plan? Do I understand how frozen thresholds will affect me over the next 5 years, not just this year, but as the salary increases? So there you have it. This autumn budget 2025 wasn't the nightmare people feared, but it quietly erodes a lot of the perks many of us relied on. If you're saving, investing, chasing financial independence, or just trying to look after your future, this is the moment to rethink your approach. Thanks for watching, and I'll see you in the next one.